notice that, this blip lower is for now just that, a blip in what has been an overall potential reversal.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlon Bowling with you. I appreciate you joining us. As always, make sure you like this video, subscribe to it by clicking that bell icon down below, and share this video with others as well. It really helps us as we build our audience from day to day. I've got Joe Camp with me of Comstock Investments as we look at Wednesday's market activity in this holiday shortened trading week. Seemed like a kind of a down day. Is that what they call a risk-off day in the ag markets here, Joe?
That was part of it. It seemed like everything conspired against the grains and the livestock too, for that matter, because we had, for cattle and hogs, an upside attempt early on. Wheat was higher for most of the session, which made us think that maybe these corn and beans can shrug off the early selling pressure and ultimately move higher again. But nope, back towards the lows and then breaking even weaker into the close. Looking at a couple of those items. For one, risk off, as you mentioned, because you see the dollar index up sharply, the stock market's down quite hard. You've got interest rates up again, and this idea that we're in a trouble spot in terms of trying to get inflation down, but seeing the Federal Reserve budge on their hawkish stance for monetary policy didn't encourage any real heavy buying interest in the broader commodity space today. The so-called leader of the commodity space as well, crude oil down again. So those outside market factors were negative. The fundamentals of the grains leaned pretty bearish. You had the latest crop progress report out that pressured prices overnight. Then you had different news items pop up here and there. Argentine prices are going lower. China might be importing more from Argentina going forward. You've got negativity over the weather forecast, providing a few dry days here or there to allow us to wrap up planning in places. You had talk about rain coming in Russia to potentially squash that storyline, at least for now. So it was a down day for sure here.
You have a corn planting progress graphic here as provided by USDA with the numbers on a state-by-state basis. What leapt off of the page when you look at the graphic screen here for the planting progress, at least on corn? What surprised you the most?
The advancement back to being above the national average for the last 5 years was the bearish influence. We could pick apart some of these state-by-state numbers, still seeing that Iowa is behind normal progress for this time of the year. Other states into the east, Indiana still trying to catch up. Parts of Ohio are not far along at all. The statewide average where it should be generally for this time of the year. But there are some trouble spots yet that exist. So it's a balancing out of what has been progress made and some catching up over the last couple of weeks, better than what could have been the worst case scenario feared a couple of weeks ago, no doubt. But yet still some concern about what's left to be planted, what could potentially be impacted by these prevent plants. You talked to David Cruz about yesterday about shifting acreage, about just generally yield penalties for what's going to be planted now and later. So that's what popped out, is just that we were back near the top end of expectations, above the 5-year average on corn plantings nationally at 13% advancement for the week. You tack on another 13% and we're all but 2 points away from finished.
It should be a pretty open week for most areas, from what I understand. Of course, a lot of areas have a lot of drying out to do before they can even get started, I guess. Let's turn to the soybean planting progress map here. And here, the numbers aren't quite as high, but in some cases, the farmers planted soybeans first. It's a little bit unusual here the last couple of years.
That is what stands out, that you have, yes, soybean plantings as a whole below corn. That's not unexpected. But relative to the 5-year average, now soybeans advance their lead from 1 point previously to now 5 points ahead of where we have normally been this time of the year. We've talked on here before about the skew of what have been some later years. 2019 has been brought up so often. That's included in the 5-year average. So it's later than we'd like, no doubt. But it's, again, like for corn, not as bad as feared. We could have some potential acreage shifting, as mentioned, over to soybeans going forward. But we're still bringing this risk of now growing season weather into play. That's why I don't think we're necessarily done with a bullish weather market, because it's a shift from wet weather planting delays to potentially all of a sudden the impact of wet plantings that could shift for a lot of areas, at least if this summer outlook holds to fruition, from too wet to too hot and dry.
You have put together a corn price graph, and I thought it was fairly fascinating. Now you're showing the US versus Brazil versus Argentina in different categories here. So explain what these different colored lines are on the graphic and what that means overall.
This is a graph that feels both bullish and bearish. It has been bullish for the US price, having been lately positioned under that of Brazil at the top. You have all of this ongoing weather risk in Brazil. Matthew's talked about it in the Comstock report. You have the staggered planting phase in Brazil being something that could actually foreshadow what we're going to have to deal with this year, where the Safrinha second crop of corn, there were some really early plantings that are being harvested now, yielding pretty favorably, in some cases better than average. All of a sudden now, though, after a month and a half where the rainy season has been shut off, everything that was planted late is going to be at serious risk of lowered yields. And that's something that we think is going to dock the Brazilian corn output relative to current balance sheet estimates from the USDA. That can be price friendly. And if we let the price do the talking, those prices in Brazil show that there is concern. There is tighter availability, less farmers selling because of lower yield prospects. And ultimately, we've held up in a competitive advantage for corn, and corn exports continue to run really pretty firmly. The negative of it is what we see, that in that the U.S. price is still above corn offers from Argentina. And it's today where, as mentioned, you have more storylines about Argentine corn export prices dropping, and this coming at a time when news is circulating about China paving the way, making the approvals to import Argentine corn going forward as soon as later this summer. So that's the negative of it. We shouldn't take away from, again, what is a considerably stronger export market for corn this season, but it's something worth watching to continue to see if we're going to outcompete Brazil, but potentially have some issues in store because of cheaper prices out of Argentina, though those Argentine prices, the downside may be limited if we bring back into play what we've talked about before, which is the corn stunt disease issue and the further realization as harvest goes on there of the overall losses.
Well, do you think that the price drop in corn and soybeans here on Wednesday was justified then, given everything we've been talking about, or did they overdo it?
It can be a bit of both, where it's not out of precedence. If we look back these last several weeks, that we make a run up, we push to new highs. We did not push out to a new high relative to earlier in the month. That's a bit more of a negative than what we've seen as of late, but we haven't necessarily broken the corrective uptrend either. And it's been if you extend it into a 2.5 or a 3-day correction after what has been a broader advancement, that's still pretty healthy in my mind. And it goes back to this shift in positioning from speculative short covering and those hedge funds turning less bearish and actually in some ways a bit bullish, and that buying interest running into ultimately some selling interest and some farmers rewarding the rally here, like they did early in the month of May, again in the middle of the month, and then all of a sudden, upon maybe some relief of getting a crop planted in some areas, some additional catch-up selling that in part also responds to firmer basis once again. It does get to a point, though, where we get into this next month of June. If the speculators are going to continue to buy in anticipation of seasonal strength, they may start to be buying at an even faster rate than farmers are selling, and that's how this rally could resume.
Corn was lower, soybeans were lower on the day on Wednesday. Looks like wheat kind of took a beating too, and wheat has had, you have to admit, quite a run here lately, even though the combines are starting to advance now from the southern plains and work their way toward Kansas. I did a report here last week interviewing one of the custom harvesters around Wichita Falls, Texas. They were just getting started there, and then they had all that severe weather went through over that holiday, or excuse me, over the weekend period. And now I just wonder how the harvest progress has been affected by that with the high winds, the hailstorms, the heavy rains out there. What are you hearing yourself?
Like has been reported to us, advancement of the early harvest in Texas is, of course, the big state thrown out there, but not quite yet in some of the biggest areas for wheat in western Kansas and on up into Oklahoma. Of course, that's how it's going to be advancing into the summer months. I think it can still be a generally drawn out enough harvest that we can think less about what we're seeing in the U.S. and still put more focus on international values. It's something that the speculators are certainly taking hold of. So unless there's any real drastic change in attitude for what we're seeing on yields that come out of this crop, I don't know that harvest advancing just yet is going to be a big source of pressure on this market. If we do, though, fast forward to say the next week and a half to 2 or 3 weeks ahead, and that harvest has hit the halfway mark in Kansas and Oklahoma and has really started in earnest for the soft red wheat across the Midwest, that's when we could see, at least briefly, some of that harvest type of pressure that is involved with farmers selling off of the combine and those commercial hedgers taking short positions in the market.
Looks like Kansas City wheat just about touched the 62% retracement. Chicago went through it and then backed off. Now what?
Well, we're still seeing that these highs from earlier in the year and last summer are above the market to be tested. That's if, we don't run into any material break of the downtrend or of the uptrend that we've been in. I noticed that, this blip lower is for now just that, a blip in what has been an overall potential reversal of the negativity we've been in since last summer's highs. And so those are the next targets any way you look at it. They do coincide with Chicago wheat needing to regain psychological support at the $7 even mark. But above this market, you only run into $7.50 and $8 for Kansas City, and those are still a ways away.
Okay, now let's talk about that livestock trade. And the cattle just jumped right off a cliff here on Wednesday. Was that related to the cold storage numbers, or what drove that market?
There was some bullishness that actually we entered into the week with after the cattle on feed report plus the cold storage update, but it faded, I think, on more news popping up about the bird flu, unfortunately, this time back to affecting an egg farm, but one in Iowa, and putting now more of the herd at risk of this being a storyline that we've got to get back to dealing with, enough that it encouraged the speculators to ditch their recently built up bullish bets. It had been a really hefty run over the last basically 20 days. And so you get that headline risk, and it's like, let's just step out, get out of the way, and see what happens here. The fundamentals are ultimately left pretty bullish. For live cattle in particular, we're still talking about a board, the June approaching expiration, and these prices below what we're seeing in the cash trade. We're not seeing a big budge lower for boxed beef prices after that historic run up recently. And the latest fundamental reports, cattle on feed and cold storage, had pretty friendly things to say about this market.
Yeah, in fact, let's look at that cold storage number on the total frozen beef. Kind of surprising. I guess we're looking at the green line on the chart for this year. And I mean, it's hardly even a stone's throw from any of the previous years.
Down 5% from a year ago. What you notice is that top line being so far removed from that. And then relative to our record high, it was achieved in 2022. We're down about 20% from there. We know about tight fed cattle supplies. They're being offset somewhat by higher weights here. But at the end of the day, production is down such that it leaves less in cold storage. And these numbers are tightening still as we enter the summer season. And while we're still pretty confident about consumer demand going forward this summer, that's been a positive that we're reminded from these reports about just how tight supplies are. Same with the cattle on feed report, whereas you have the total on feed number down to a 4-year low for this month, the placements for April down to a 9-year low for that month, and ultimately still hard to come by these market-ready cattle all of a sudden again, and that's friendly and has been for prices.
Now, if we look at the cold storage graphic for pork, total frozen pork, I mean, it's lower than the last couple of years, but not as low as it has been. So maybe not quite as bullish as on the beef side. What do you think here?
Exactly, less bullish. You have it's still down from a year ago by about 12%, but the standout item from that last report was that it was up on the previous month by about 8%. Normally in the month of April, they would build about 3%. It's just seasonally, the pork stocks are growing at a faster clip than what we'd expect. Now, the flip side of it is that production is expected to tighten further into the third quarter of this calendar year. So we could see these pork stocks level off once again. It's going to partly depend on if we can get pork exports resuming their strength. We've had record years of pork exports. We're expected to go forward into new record highs again, but lately they've been a bit sluggish, and that's in part been to the response of higher prices that were reached during the month of April, and then most recently some negativity for the export market because of a firmer dollar.
On the lean hog, the nearby lean hog chart, I mean, it couldn't be much more oversold right now. It looks like it's really searching for a bottom right now, but does that help the cause to, at least if nothing else, create a short-term bounce off of where we are?
I think it can, but where I've been cautious is the technical factor that we talked about last week, in that it had formed such a clear double top on the charts that if you measured a basic extension, it could still involve another couple of dollars lower before you have those breakdown measurements reached. But for now, yeah, you talk about volatility, the Bollinger Bands, many of the retracement levels, they've been reached. And so some stalling out of the selling potentially here early this week, but still 2 down days. So nothing great.
Equity markets had kind of a rough day. Explain the connection there. Is there still a correlation?
There is worry overall about interest rates and where we're headed there, about the response to persistently high inflation and what the Fed's going to do about it. There's going to be more talk of this later this week. Friday morning, the Personal Consumption Expenditure Index report will be out. That's the Fed's so-called preferred measure of inflation. It's expected to remain about steady on last month at an annual rate of 2.7%. If we start to see some easing of expectations for monetary policy and the thought that they could start to go lower yet later this year, interest rates, that would ultimately be a better recipe for strength in the commodity space. You'd have potentially some settling down of a stronger greenback like we had today, and less negativity if the stock market's going to also cheer lower interest rates ahead. But that's the reversal situation of what we were dealing with today.
Well, Joe, thanks for explaining everything. Great to visit with you again. That's Joe Camp. He is with Comstock Investments. And that will do it for this episode. For producer Brianne Hendrickson, I'm Marlon Bowling. We'll catch you next time right here on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.